Welcome back to the Insurance Lab, where we turn the extremely niche world of property and casualty insurance into something almost resembling entertainment. I'm your host, Ben Stern, managing partner of Heffernan Insurance Brokers, and occasional therapist for clients who just got their renewal quotes. Today's episode is going to be a heavy hitter. We're diving into one of the most complicated and legally radioactive sectors out there, security guard companies. If you think underwriting apartment buildings was stressful, try covering a company full of guys with badges, batons, and a tendency to write incident reports like they're auditioning for cops. Joining me are two absolute pros, Chris Dewey and Zach Catanese, both with Heffernan, both specializing in security insurance, and both apparently gluttons for punishment, because this is not exactly a stress-free industry to insure. Chris, Zach, thanks for suiting up and jumping into the fire with us today.
Thank you for having me.
Thanks for having us.
I've been looking forward to this one. This is a really interesting topic, and we talk about this all the time, and this industry fascinates me. So let's start with both of you guys. You can jump in whenever you want. Mm-hmm. Let's start with the obvious. What makes insuring security companies such a perfect blend of legal risk, emotional damage, and underwriting migraines?
I think it's just it's difficult right out the gate. You taking the industry, right? So you're taking a lot of, majority of it's observe and report, but you're taking an industry where there is quite a bit of risk from the get-go, and then you're then saying, okay, well, now we have to insure it, and so then you're getting a small amount of insurance underwriters as a whole that are like. If you take any industry, you say, okay, yeah, let's take a look at that. But then you say security, that wipes out 90% of the insurance carriers. And so now you're left with this small group of underwriters that are now, they're also pros in the industry as well, but are taking a look at this risk and deciding to say, okay, how can I underwrite this profitably and still somewhat be competitive in the marketplace? So I think it's difficult all around. I think it's difficult for the insurance carriers involved, also too for the security clients that are navigating through this space, and especially some of the contract stuff that we had discussed previously before. But there's just a lot that's going on that gets taken into consideration.
Yeah, especially for the the underwriters that we talk about. Like, it's such a small market as it is, anyways, and then they have to underwrite these security guard firms that might be brand new in the industry. And they're trying to get as many clients as they can. And one way to do that is they just sign the client's contract. And these security guard underwriters have to know that there's a potential that they're going to be paying for a claim that they have no clue that they didn't underwrite for.
Right.
They just didn't capitalize on it and know exactly what they're getting into. So yeah, it makes it difficult.
Chris, how many markets are there generally for, let's say, general liability, workers' compensation, excess? Like, I know it's a limited amount of markets, but what do you think?
Like, just for the security guard space?
Yes, just for security guards.
So, you're probably looking at maybe 9 on the general liability side, and not saying all 9 are competitive.
Right.
And those are the guard programs. Those are specific to the guard programs. That's not including the the wholesale marketplace that has. These are MGAs, managing general agencies, and MGUs as well.
And then it gets defined. It gets dropped out even further, right? Like, okay, I can do armed. I'm not going to do armed. I'm going to only do unarmed. Or you do cannabis. We're not going to do cannabis.
Low income housing.
Low income housing. You can do so. When you're saying, hey, I'm a security guard and I want to do event security with low income housing, you're probably looking for competitively. You're probably looking at maybe 3.
And you're probably not going to get those out of those 9. I would maybe not even. I think 3 is probably a stretch. I'd say maybe 1 or 2, and then even those 1 or 2, they may decide to say, "Hey, you know what? We're not a huge fan of this," and you have to then go to the wholesale marketplace, and that you go there, and you're going to find something out there. You'll find an option. It's just not. No one's really going to be willing to pay for it.
It's more expensive.
Yeah, absolutely, significantly more.
And when we're looking at, especially your smaller to middle market security guard firms, revenues under $10 million, they might not just have that priced in, right? they want to get into event security. They want to get into low-income housing. And they've been using their rate structure that they've been using on corporate office business parks, right? And they go into these new sectors, new niches, and they're just trying to figure out how to pay for it. And all of a sudden, there's going to be the next layer, which is, you have to get excess now. And the excess limits are going to be tough.
So what I'm hearing then is, let's take a company that was underwritten as, putting security guards in office buildings.
Yeah.
Sit halfway through the policy, they get a contract to put security guards in affordable housing. Will they contact you? Does it get picked up on audit? How does that work at renewal? Does it complicate things? I'm guessing that it does.
Well, a little bit of both, or I'd say all the above. Sometimes they contact us out the gate and say, "Hey, I'm looking at this contract. Can you please take a look at it? Can you review it? Let me know what your thoughts are, and then can you run it by the underwriter?" And now that's some more I would say more higher level. It's like saying, "Hey, take a look at this. Let me know if my policy is gonna if there's any exclusions on our policies that are going to restrict me from doing this type of work."
Right. They've had claims enough that they know that the coverage is extremely important.
Yes. Yeah. So you'll have low income housing exclusions. Sometimes you'll even have a retail exclusion. But you'll have all these exclusions on the forms, and some of the clients that are well versed will reach out and say, "Hey, can you review this?" And we'll let them know, hey, green light, or you know what, no, that's not a green light. We're either going to have to replace coverage or get the carrier to actually schedule that operation, which that's hard to do as well. I mean, because that's to get in a carrier to then say, okay, hey, wait a second, now we have to add something on here that we didn't rate for initially. So they may do a re-rate right then and there on that one operation, and that's one type of client. The other client is the client that just decides to say, hey, I'm going to take the contract and we'll deal with it at renewal. Yeah. And then we find out at renewal that operation's on the supplemental application, and the current carrier's like, wait a second here, how much of this business are they actually doing? And they thought, wow, this is 25% of the business and it's actually excluded now. And so you then run into that, and then you now have a carrier that's saying, hey, you know what, we're going to non-renew.
Right.
So that happens, and then sometimes there's a gray area where we're not even notified, or this low income housing or certain types of operations may be classified as something else on the application, and that can get kind of sketchy too. So it's an
example would be like something that we don't find out about. Hey, I only do office business parks. Okay, fine. Is there any cannabis there, or is there any bars, nightclubs there? No. Don't worry about it. Well, all the underwriters are using Google Maps, and so they can look to see who the tenant list is, and who the tenants are, and what's there. And so you end up finding out
that there's a cannabis shop in a strip mall, right? And so you might have a guy that's doing all these strip malls in and around Southern California, and you're thinking, okay, it's just retail. It's just going to be a CVS, Walgreens, a couple different stores in there. But then you find out that the underwriter looks under the hood, sees that there's cannabis here and there, and now you've got a big problem. Yeah. Now you've got and the client's saying, well, wait a second here. I'm not providing security for the cannabis store. I'm just doing exterior patrol, parking lot patrol. We do nothing on the inside. And they may not even been aware that there was a cannabis store, because they're not looking at each individual tenant. They're looking at who's the contract with this this large commercial property that has a bunch of these strip malls, and they're not necessarily looking at each individual tenant.
Right. So the concern then is, cannabis store. Let's say that it was held up at gunpoint. Somebody runs out, right? Hits somebody, injures somebody in the parking lot. On the way out, the security guard company can get pulled into that, right? Yeah. Even though that they're not providing the security at that location.
True. Yeah, true. And I think what we would say is, even if it sounds like it's potentially bad news, let us know. Let the broker know. Don't try to hide it under the hood, because it's going to get found out.
So Zach, full telling you everything. You can avoid problems at underwriting at the last minute, right?
Exactly.
Yeah.
Right.
Yeah.
And I'm guessing there's situations where you ask for the supplemental application, you ask, you get it. It's like 30 days before. You look at the sup and you go, wait a minute, where did this exposure come from, right?
Yeah.
And it puts you in a challenging position.
Yeah, and not only that, with that challenging position, because sometimes I'll have a client that will discuss, like for instance, it was low income housing, and they were like, "Well, we're looking into this. We're looking at," and I'm just like, "No, you're not." I'm like, I mean, you can, but you're gonna, you have to price for it, right? You got to make sure that when you're going into this and you're actually working on these new contracts, that you're pricing from the exposures that you're picking up. And so we do often at times we'll have to say, hey, just try to stay away from this, or if you are going to do that, it's gonna cost more, and we're going to be limited on carriers.
Kind of speaking about pricing into it, and this is just a different aside, but I think one of the things some security guard companies, actually a lot, fail to do is I think the best thing you can do is figure out a blended bill rate. Hey, if I'm billing a client this is what my GL cost, my work comp cost is, my auto cost, my umbrella cost, my payroll, all of that is in that blended bill rate. And so I think at times our clients will come to us and they didn't price for it, and now they're underwater on a contract.
You got to build in enough margin on that contract, and then also knowing too, if it's higher exposure, if it's going to check one of those boxes for retail, cannabis, low income housing, housing in general, even apartment buildings,
event security,
knowing that you are going into that, you should probably price for that with your contract, and then that way when you do get charged for it, if you are getting charged for it, you're able to. It's not there's not such sticker shock there when you come back around for renewal.
Okay, so from your vantage point, then, is this market for security guards specifically? Are we in a hard market, a soft market? Are the underwriters clinically depressed and heavily medicated like the rest of us? Like, what's going on?
I would say we're definitely we're in a hard market now. It's been going on for about 5 years now, and it was much more of a whiplash before. When it first started hardening, it was just it caught us off. We could see the claims coming in, but the market just shifted so rapidly. I want to say it was like the fall, September, I think, of 2019, where all of a sudden everything just basically started turning, and then it just continued to turn. And all of a sudden, I don't know, I would say the last 6 months, I've started to see some leveling off. I've started to see some more capacity, basically meaning more carriers coming into the marketplace.
Some of the carriers that already somewhat priced themselves out, they saw these claims coming. They might have either had them, or they just had the basically foresight to say, hey, we need to start pricing this. And so they're coming back into the game. And so I don't know if it's necessarily, it's still a hard market, but it's like hard, but kind of stable.
It's stable.
It's a stable but hard market.
Yeah.
Okay.
Yeah, because
no longer a race to the bottom.
Yeah, it was a race to the bottom before, and then a bunch of programs blew up, or carriers got out, and new players came in, and for a while there there were some carriers that are now priced where they're at, and they were priced there 3 or 4 years ago, and we were like, whoa, like that's not nowhere near competitive. And now we're looking at it being like, wow, that's a good deal.
Doing.
Yeah.
Right.
So they were underwriting conservatively and putting certain business on the books and things like that, so they could have a program that would last for as long as it can. They want to make sure that it's not going to blow up, and they're not going to race to the bottom again.
Right.
And you saw the hard market the prices kept going up as claims kept. There were some pretty large national claims. The Seaside in Florida. The largest claim paid out was by the security guard company at $517 million.
Oh, no. Why was the security guard company liable?
I believe they said it was a failure to use the intercom to notify people to get out of the building.
Oh, right.
And so they ended up paying about half of that claim. And Rancho Cucamonga, 2023, there was a $55 million payout from a security guard doing affordable housing. There was a shooting relation, not the guard, but they're saying you failed to protect this individual.
Right.
And I don't even know if they were on that property or whatnot, but you see these big claims coming in, and these carriers that are already limited have to scrutinize even more.
Right. And a lot of the claims get pushed down to the security guard companies based upon the contracts that they sign, especially with the large real estate firms who have legal departments, and it's take it or leave it, right?
Yeah, pretty much.
Yeah.
And on that side with the real estate departments, right? You're doing a real estate deal. Those carriers want the security guard to indemnify and hold them harmless, right?
Right.
So
it's what I recommend
Yeah.
with my
Right.
real estate clients.
yeah, it's like we're fighting with each other.
Exactly.
Yeah.
Yeah. Well, but kind of going back to some of the contract stuff, one of the things that we're always suggesting is, making sure that, whoever you're signing, if you're signing their contract, have them sign your contract as well. Add it as an addendum. Obviously have your attorney review the contract to make sure that you're not giving up everything and all liability, because that's what we often find is that even a slip and fall on a property, security guard's now responsible.
Right.
Because they were in, it could have been a puddle, could have been a crack on the floor that they didn't identify. There's just so much that encompasses security with what you're responsible for creating like a safe environment. Like anything under the sun, you can get pulled into.
Zach, you and I talked about this. Tell the listeners a little bit why it's important to have both those contracts signed.
Well, because at the end of the day, you're gonna, when you receive a summons and they, try to figure out, okay, who's responsible for this, and they go in and they look at it, okay, well, the property manager had the security guard sign a contract that, there's going to be a hold harmless agreement in there to a degree, but ideally you're holding each other harmless and you're not passing all liability onto the other party. Now, but if you have both parties sign each other's contracts, well, essentially, if you're the security guard company, you want to make sure that that both parties hold each other harmless and they're not giving up too much there. And you protecting yourself, and that way you're not covering anything and everything that the property manager whatever happens on the property.
It gives the security guard company a fighting chance.
Absolutely.
That it's not going to hit their policy, right?
And it may not actually.
This is very important, by the way.
Yeah.
Here's an example. We had a security guard company in Los Angeles, right? So they're just doing a small retail center. There's a restaurant on it, property owner, and they're doing basic stuff. Check the doors at night, make sure everything's locked up, observe and report. Well, there was a fight at one of the restaurants. Their contract doesn't even stipulate they're looking at this restaurant, but it's on the property, on the premise. Well, as soon as that fight happens, the losing party of the fight sues the restaurant, sues the property owner, and it sues the security guard company. The security guard company is already now going to be paying for the defense costs of the building owner, and they have thousands of dollars now in this claim because of how the contract read. And so if they could just shift that around, they could have a fighting chance.
Right.
Because the property manager is going to try to pass off any and all liability.
Yeah.
Off to, and again, that's usually suggested by the retail broker for the property manager.
Yeah.
Right.
So again, it's trying to be savvy enough as a security guard business owner to read the contract and say, you know what? No, I don't think that's necessarily fair, and I'm not going to sign that, or if I am going to sign that, you're going to sign this, or you push back and you get them to change the wording in their contract. Now, that doesn't always happen because they may just go find the next security guard company that's willing to take that contract. On some of the more complicated contracts or security guard companies that provide a more specialized type of security, there's a little bit more leeway on the contract, and the guard company is able to review it and say, you know what, I don't like that. Let's change the wording on that. Let's do this. Or they've had a long-standing relationship with that property manager company saying, hey, I get that your legal says that, but you leave us open to everything. So here's what we're willing to do. And so it's, there's some give and take.
And we are seeing some carriers even fighting back on that, though, as well, saying, we want to see some of your contracts, at least maybe for your top 4 or 5 clients. They want to see that. And if it's putting all of the indemnification or legal liability on the security guard, they might not even offer to give insurance.
Yeah.
Right, because the prevalency of claims is so great that the carriers know that to utilize this as underwriting information, right?
Eventually, we're going to be paying something out that we might not have priced in.
Right, and some of these claims, there's a latency, right? I mean, like you may not even know that there's a claim for a year or two, right?
Yeah, yeah, exactly. I mean, and that's a part of the problem. I mean, and a lot, and also too, when you look at how these carriers are rating, right? they're rating everything off of what they're seeing in the rearview mirror. And what they've seen over the last 5 years, especially with like nuclear verdicts, it's been messy. And so that's what's been driving the hard market. And so, they now look at, so once the claims start to get cleaned up a bit, they're still, they still know that they're going to be on the hook again for probably another year or two. So even once which I kind of feel like that's where we have some stability in the marketplace, is they finally feel like, okay, we're charging what we should charge. We know that we've seen the claims over the last 5 years, how they developed. We know what's going to be coming in the next year or two with claims, or at least try to predict that. And so that's where we see some of the stability right now with the pricing.
Mm-hmm. Right.
Yeah.
I want to talk about risk management and your experience with claims, but before then, maybe talk to the listeners a little bit about your background, right? How'd you get into insurance, and how did you specifically get into the security guard business? We'll start with Zach.
Okay. I got into insurance right out of college.
Who'd you work for?
Federated. What I liked about Federated was they offered it was like a 10-month long training program.
Good program, good training
so
program.
I wasn't a doctor. No, I wasn't a CPA. So I figured I better go somewhere where I can, get taught, an industry, a specific niche, and try to become a specialist in it. So when I had the opportunity to that, I was chomping at the bit to leave Tempe, Arizona at ASU to go to Owatonna, Minnesota.
It was exciting.
We basically crossed paths.
The coldest place on earth.
Wait a minute. I just got to tell the listeners on this. So you play football at Arizona State. You're at ASU. You're on top of the popularity. Right? It's a great place to play football. And then all of a sudden you find yourself in Minnesota on a Tuesday night.
Exactly. And it was
what was going through your head?
Owatonna.
By the way, we're
cool
laughing because
place.
you're from Minnesota.
Right.
Exactly.
Yeah. No, it was. I would say everybody should go there. At least once. Check it out. Minnesota was great. I have some family from Minnesota, but it was great because I was there with like 20 other individuals that were in the same boat as me, all from across the country, and we had a great time. I mean, it was insurance from 7 to 5 every day, and then we'd go hang out in Owatonna or the Twin Cities, and I mean,
did you go to Little Ditties?
No.
Does that even? Do you know what that is?
No, I would say
no clue.
It was a piano bar in the Mall of America.
No. With two, I think it was Whiskey Pete's.
You played like double, it was like the twin pianos.
All right. Bootleggers was one of them.
Bootleggers was pretty good.
Bootleggers was good. We'd spend a lot of Friday nights there. But then we would go to Winona State. We'd go to Mankato State. We'd go kind of visit all the. I mean, we were 23, at the time.
That's where you want to be when you're 23. It's Owatonna, Minnesota.
And just running around and creating mayhem.
Yeah.
So, but Anyway, I'll kind of fast forward. Did worked for Federated. Then I actually worked in Southern Arizona for about 5 years, and then you and I met, and you saved me from Arizona and said, "Hey, come to Southern California. The weather's always, 72 and partly cloudy. It's beautiful here."
Right.
And so I did that, 12 years ago?
12 years ago.
Yeah, and then got into the security guard industry right away.
I got to tell the listeners real quick. So I met you. We had a great time. I told my wife, we need to get Zach over here. So when you flew out from Tucson, I put you up in the hotel in Manhattan Beach at Shade. And it just so happened it was like the Little League parade was that day. It was like 72 degrees. We had a great dinner the night before. Jimmy Kimmel was there at dinner.
Oh, yeah.
And I just remember thinking I could not have planned this out any better. There's no way he's not going to come. And that's
easy
amazing.
Sell.
It was an easy sell.
Yeah.
It was an easy sell. So know your audience, right? And go big on these things.
Yeah. But then just to kind of wrap this up, make a long story longer, but immediately once we started working, we ended up kind of identifying the security guard industry as a niche that was, I wouldn't want to say, there weren't a ton of brokers kind of focusing on that industry.
Yeah.
And it was I wouldn't say it was kind of underserved. There was only a handful of people that were doing it that we were aware of, and I identified that and thought, okay, well, I'm going to learn anything and everything that I can about the security guard industry. And that was 12, 13 years ago, and the rest is history. Now it's basically it's we do work in other industries, but it's the one that, I think, like Chris and myself, it's...
Yeah. You became a student of the industry, learned everything, the forms, the carriers, the players in the industry, and just served an underserved market.
Yeah.
And we should probably give a shout out to Jim as well.
Oh, yeah. First security guard client was Jim Woolen with Nationwide Guard Services.
Yeah.
Who's also a fellow of Sun Devil. And, I do thank Jim for giving me that first meeting when, I kind of dropped the football alumni info with him and said, hey, man, let's schedule a meeting and chat, let's talk shop. And, Jim's
how's Jim's golf swing?
Oh, man. You know what? It's better. It was a lot worse.
Definitely better than mine.
Yeah. He's taking lessons every now and then, I hear. But, for a while there, he was just going to just take this bad swing and just, keep working with it and just say, hey, it is what it is. But he's doing a lot. He's actually, his thumb isn't so far out on the outside. He's got it kind of over the top now.
Right.
So he no longer has this huge banana slice, and he's either playing a straight ball or a slight draw.
Speaking of improved golf swings, Chris Dewey, what's your
the golf swing's still not there yet. We're working on that one. But I pretty much passed Zach on my way out. I'm from Minnesota, and I've been with Heffernan for about 17 years now. And when I came out to California, up in the Bay Area, I had to get a job. And so I actually first started right out of college, worked for Cintas, the uniform people, great company. But my dad has an insurance agency back in Minnesota. I used to be his free intern because why pay your son? And I like doing it. And he was trying to get me actively in insurance as soon as I moved out to California, and interviewed with a couple different people. It was more on the life health side, and I wanted to make my own path. And so I met a buddy, Sal Galati. He was over at Liberty Mutual, works for Amwins now in Chicago. Met him at a bar in Danville, and he's like, "You got to get into insurance." And he knew John Tallerita, who's CEO of Castero Brokers, and met JT a couple of times. And he said, "Hey, I think you should work with us." And there you have it. I worked in our small business unit for a couple of years.
That's interesting. So you met JT, and then you started in the small business unit. You were in Walnut Creek, weren't you?
Yes, I was in Walnut Creek, and there were probably 25 producers, probably all under the age of around 30-ish.
Right.
So like 25 to 30. So it was a great learning just about insurance, and it was a lot of transactions, but what I realized is throughout that process, we were doing, and nothing against these industry classes, we were doing a lot of construction, we were doing a lot of nonprofit, and I do some of that as well. And when I came out of that, I realized, kind of like Zach, there's an underserved area of insurance, and it's almost all security guard agencies. And I knew at Heffernan there was not really that many brokers doing it, and so I knew I could also, grow myself if I learned this class of business, meet clients, and I wasn't even gonna have a lot of inside competition. So up in the Bay Area, especially. So, have been doing that now since then.
Do you remember the first security guard?
Yeah, Cypress Security.
Cypress
Security, Kess.
Wait a minute, I know Cypress Security.
Yeah. You do know Cypress, yeah.
We just saw him too, a couple months ago.
Yeah, so that was our my first account, so it was great. Yeah.
And then I met you because I was working with JT here, and I was going up to Menlo Park frequently, and I met you, and Justin was there, and Josh Fagan was there as well, and then somehow I convinced you to go on a weird, crazy trip. Yeah, and that was just a weird coincidence that you ended up going on that trip with me.
Yeah, I mean, that was a fun experience, that first Burning Man trip with you. So
we'll have to see. We're going to save that topic for another podcast. Things seen on the playa.
Exactly.
That's really funny. What are some of the strangest claims that you have seen in your experience? Just strange.
The craziest one I saw, security related, was our guard provided exterior patrol. They just hang out in their patrol vehicle, and this was at a mall. Okay, somebody this kind of goes back to the contract we talked about. Someone slipped and fell on an ice cream cone inside the mall. Our
Was that
guys are
soft
just
serve
outside.
or
I
hard
think
serve?
it was probably. I think it was a swirl soft serve.
Yeah, right.
Those
they're
ones are extra
very
slippery.
slippery. Yeah.
Yeah, and we got pulled into that, and we ended up paying, I think, almost all of it. It was us splitting it up with the janitorial company, and we were outside the whole time. We had nothing to do with the interior, so that was a pretty wild one.
Yeah. Zach, I kind of feel like we've seen similar claims like that, right? In
yeah,
the food courts.
There was one in the food court where a patron slipped on. They had ordered nachos, or maybe it was a pretzel with a nacho cheese, and spilt the nacho cheese. Their own nacho cheese, slipped in it, and was injured. And somehow the security guard became responsible due to the contract.
Right.
So that ended up being
It always
a
comes
messy
back
one.
to the contracts.
Yeah, and it was, and you look at too. You just look at the size of the claim as well, and you're like, really, like this is an exorbitant amount of money for, just you think that maybe the attorneys were pushing a little bit there, right? They're looking for deep pockets, and I think that's often what we find is, when something like that does happen, people tend to push those and try to get as much as they can. So.
Right. Now, if both of you guys were handed the keys to a mid-sized security guard company, we talked about contract review. What else? What would be after contract review? What's the second and third things you'd focus on?
I would find somebody to sell it to.
It's a tough business.
Right?
If I were to, I'd probably do the same, Zach. But if I were to get the keys, I would probably try to figure out how I can budget in a lot of employee training and having like a really good ops person. Security guards in actually pretty much everywhere, there's a high level of turnover. And when you have a high level of turnover, there's a bigger potential for workers' compensation claims.
Right.
You talk about your report writing at the beginning, like, okay, this employee's been with me for 3 days, and I have to get them to do all these report writings. I have to know, hey, what's their experience like? How are they out in the field? Okay, they got to go take care of this contract now. Well, and then 2 weeks later, they no longer work for your firm, and you're doing the same thing again. So figuring out how to do employee training and employee retention, that's tough, though, in such a thin margin company. But if you can figure that out, or if I could figure that out as a security guard owner, how to get that correct,
right?
I think there would be success.
And
I think when we look at successful security guard companies, they have a lot of that. Like, here's our ops training, here's our report writing, here's how we are trying to keep long-term employees here. We have a local one right down the street that they've had some of their employees for 6 years, which is insane. And they've got maybe a 20% turnover rate, which for the security guard industry is very low. It's not uncommon for it to be 100% turnover.
Right. That's a good question on this one. What for this particular a company you were talking about?
Yeah.
What are they doing differently that they are keeping their employees that long?
I think they pay really well. I think they get into contracts where they know they can be successful, and where their background is. When I look at them, they are very defined on this is what we go after, this is what we don't go after.
They're specialists within that niche.
Within that niche,
exactly.
Right.
And so you'll see that. I think that's. I think what I was going to piggyback off on that one was, just if you're going to run a security guard company, try to focus on a niche. Don't go in after anything and everything. Don't throw spaghetti on the wall and see what sticks. Try to figure out where you're going to be the most successful at. Mm-hmm. Focus on that area, and then basically kind of branch off of that without going too far.
Right.
I think that's where you're going to have the most success. And everybody probably wants to go after high margin business and doesn't want to focus on a low margin business. But at times, maybe it's the low margin business that just pays the bills, and they have to do what they have to do to keep the doors open. So it's a tough balance, because you don't want to say no to business and and lose an opportunity. But then again, too, you got to look at what's the liability with that?
What's the 5-year plan?
Yeah,
right.
Exactly.
Like, am I gonna be able to afford insurance in 2 or 3 years?
Yeah. Yeah. So when you're looking at like industry, right? So all of the industries that are really tough to insure, someone has to provide security for
Exactly.
that. So, so if you are going to go after that, make sure that, you have that super, super tightened up. Like I've got a client that only does affordable housing.
Yeah.
And they have very little to no claims. And it's because it's a smaller operation. It's ran super tight. The owner's highly involved.
Right.
He said the same guy's working for him for a long time. He pays him pretty well, and he knows how to run that specific niche.
Right.
So it's like you have that, and then if you're gonna, some of the other niches too, you just focus on that, figure it out, and then find a way to make money in it and keep your employees.
Would you say, with the companies that you've worked with that have great claims history, which is really what we're looking at, right? We want to keep premiums low. Are the owners, do they exhibit leadership qualities that you've seen in other industries, that you've seen with maybe coaches? Like, what do you see that is the differentiator?
Yeah, I would say you do. You see, it's like a head coach, right? You see a lot of that with the qualities of, are they involved in the business? Yes, they're involved in the business, but they're also able to delegate in a manner where, the people that are an arm's length away from them are basically an extension of them.
Right.
And, so everybody's on the same page. So the director of ops, is basically it's dealing with what the CEO's kind of messaging is and kind of what the plan for the future is. So I think that's a big thing, is just making sure that if you are the CEO, and they're very much so, a lot of them are coach-like, you're not spread too thin. You can't be everywhere at once. Because I have seen clients that there's not it's such a flat organization that the CEO is doing basically everything having all these guards, and there's not as much supervision as there should be.
Right.
And so that's where you tend to see more claims. So where we're seeing less claims are when the CEO or president has those supervisors or director of ops or different directors of security, or just different people in line that can relay the same message from up top, and then get that all the way down to the bottom and have everybody on the same page. And also too, just making sure that everybody feels valuable,
Right.
like they're at a good place that they want to work
Right.
at.
So it's actually what I'm hearing is that the really good operators are creating a why for the people that are working there.
Yeah.
Why are they coming to work every day? What are they doing while they're there? And what is the long-term goal for the company?
Yeah. What do you think, Chris?
I mean, you kind of hit it right on the head.
Okay.
Yeah. I agree with that, though. You see the owners. Sometimes you'll see some security guard companies where the owner, and I get it, they're trying to grow their business, but they're very focused on just getting more business rather than looking at what they have and making sure that the employees are supported and making sure that, hey, this is the direction of the company. This is what we want to see it as. The ones that have that oversight of their employees and their relationships typically have less claims.
Right. Maybe
And it's not
having
saying
an
that
abundance mentality too, and a positivity.
Yeah. It's not saying there won't be, but just less.
Yeah, I mean, Zach, I've seen some of your clients that are amazing leaders. I mean, there's some folks that, if they weren't in the security guard industry, they'd be in another industry, winning and running a company and doing an extremely good job.
Yeah.
Right.
Yeah, they're good business people. It's security or not, or whatever other industry they're going to do. So, yeah, they just they're sound-minded, make good decisions, and recruit and hire good people.
Yeah. Are you seeing any risk management devices like body cams or drones, or are you seeing anything on the horizon that's making the industry more shielded from claims, work comp, or general liability?
You see a little bit of body cams. You see some the tracking of the guards, whether it's mobile app or if they use a third-party vendor to track what they're doing.
If they're doing foot patrol, they'll have some type of guard tracking system. They may have like I know malls use Case Global a lot. They'll use that, and what'll be kind of cool is it'll have these little tags all around the site, and they scan it each and every single time, and then and that's for foot patrol, and then vehicle patrol. You've got some of these other programs that that are pretty good too. And I'm thinking more so from drive cam systems like Lytx and Samsara and Azuga. I think the drive cam systems are probably if you have a vehicle and you're doing any type of patrol, or if you have any type of security vehicle, you should have a drive cam system.
Absolutely.
And I've seen that save clients millions of dollars on actual claims.
Yep.
Is that because the video is there?
Oh, absolutely.
Used in defense?
Video is used in defense, and it is, whereas it's, had that video not been there, the claim would have just been pinned on whoever had the highest insurance limits. And
right.
Because I'll give you an example. There was one claim where there was 4 vehicles involved, and the security guard company was one of the middle vehicles. The vehicle behind him rear-ended him.
Right.
And pushed him off the road.
Right.
Or pushed him into another vehicle and into a motorcycle off the side of the road, and caused this big accident. And you could see on the drive cam, you could see the guard driving at speed limit. You could see him stopping. You could see him look up in his rear view mirror saying, "Oh God, like please stop," like
right
before impact. And then you could see him being rear-ended, and then the whole incident take place. And the guy that hit him didn't have super high insurance limits. So, but everybody else had this not been filmed, it would have been all pointed back to the security guard company. Security guard company would have had to pay out, or the carrier would have had to pay out full limits, and then that would have been on their loss history for the next 5 years.
Right.
I mean, yes, it's still in the loss history for defense costs at a much smaller amount. And yes, there was a little bit of indemnity payment, but overall, when you look at that that one incident that was being filmed saved that security guard company from being non-renewed, insurance tripling or quadrupling down the road, all because of having, one piece of, technology that's kind of covering their butt.
Right. So just off the top of your head on this one, we know how big of a claim that could have been.
Yeah.
You know how much they were paying. What do you think in 1 year savings just on premium alone? Without having that loss in a loss run.
So you're thinking, that potentially could have been $2.5, $3-4 million claim, and ended up settling for, I think defense was like $150,000, and maybe they settled that for $100, so it was like $150,000.
Right.
Their premium at the time.
I mean, that saves their business.
Yeah, saves the business.
That saves their
time.
business.
Right.
Yeah.
Right.
Yeah. So that investment in like a drive cam.
Yeah. And
how much does it cost generally?
For drive cam?
Yeah.
It depends if you lease the cameras or you buy the cameras. Most of them you probably lease, and it just depends from company to company.
It depends on the size of the fleet as well. It depends on the size of the fleet.
There's a couple carriers out there that'll pay for it too.
Yeah.
If they're doing the auto, they'll pay for it.
Right.
Well, they'll do some of them will pay for a plugin where you'll get a bunch of the tracking with just a plugin that data goes back to the carrier. They won't actually pay for the drive cam.
Right.
But they'll give you pricing on like favorable pricing on it.
Right. So, I mean, I guess what I'm hearing too is, not all policies are equal.
Yeah.
Some policies may have some bonuses that may make the risk better and save premium in the long run. So if you're just looking for the lowest cost, well, it may be the lowest cost, but it may not be the lowest value as well, right?
Yeah.
So value is important when you're looking at these policies.
Yeah, absolutely. The initial with some of these clients that I have that were kind of reluctant to add drive cam systems. Mm-hmm. At first, they were like, you know what, we really don't want to see what's going on.
We don't want to be Big Brother.
We don't want to be Big Brother. We're worried that whether it's going to be employee retention or also too, we're worried that it's going to get used against us because we know our drivers are doing stupid crap or falling asleep or whatnot, and I'm like, I kind of was talking to a few of them. I was like, well, wait a second here. You've got this huge fleet. You've got all these cars on the road. I mean, that's it. The potential of a catastrophic claim is very, very high. Like, and if you're doing all the risk management, things right, and you're all the driver training and distracted driver training, and you get the cell phone policy and then all your other driving policies. If you're doing all that right, then the camera shouldn't be really a problem.
Right.
And employees, what I see, they push back on it initially.
Right, but they feel that somebody's watching them.
Exactly. Yeah.
Is the camera inside the inside and outside?
Depending on how you have it set up, you could have a forward facing with.
There's usually always one. Well, they have one on the driver, and then one rear end.
drive.
Right.
Yeah.
So and it's I just think it's money well spent, and overall your employees get used to it, and at the same time too, like so it's kind of interesting with the drive cam is you can set it up to where it's like any little incident gets sent to the supervisor, or if it's only going to be before and after an accident or high speeds, things like that. It's all data that's tracked. And you can also reward your employees for safe driving.
Right. So you can put a system in place
saying, hey, you know what? We've gone a month and you've had no driving infractions.
Right.
Which and an infractions could only be considered like, oh, you're 5 miles over the speed limit, 10 miles over the speed limit, or you did a patrol and you forgot to put your seatbelt on. It picks stuff up like
so
that.
Reward the good behavior,
Yes.
right? And that's
Yes.
how it's framed.
Yes, exactly.
That's true. It's when you have children, you do the same thing. Reward the good behavior.
Yeah, exactly.
Especially for security guard auto, because when we're talking about tough markets,
Oh, God.
general liability and excess are tough, but
That-
security guard auto is
Auto's a little bit of a mess.
Oh yeah. So
Yeah.
auto is still hardening.
Yeah.
Where you haven't quite seen the ceiling on that one.
Yeah.
But it's difficult because it's yes, the claims and the exposure, but also to the markets, right?
yeah.
How many markets are there generally?
We could talk monoline.
Depends on if it's national or California, right? Yeah,
Yeah.
monoline.
Well, monoline there's only a few. Well, it depends, right? Well, there's a few, and then if you use a wholesaler, you then have maybe another 10 markets, but those markets are like they are 2 to 3x higher than those 2 to 3 monoline, and then you have these other auto markets that are attached to either a general liability product or a work comp product from the security guard markets. Now, if you can get it done there, if you can get the auto done or attached to the work comp or the general liability in a security guard market,
Right.
that's going to be the most affordable auto insurance.
So that's interesting.
Yes.
So
Yeah.
if it's attached to the work comp, really putting some work into claims and preventing claims on the work comp gives you access to
Absolutely.
auto.
Yeah.
And in this market with auto, you got to do everything possible to put the odds in your favor, right?
Yeah,
Exactly.
Well, yeah, and then I think though talking to a client too as well, who's looking at it and say, well, that work comp's 10% more, and it's like, well, your auto is significantly more over here. If we're able to pair this work comp that's 10% more with this auto product, that's going to save you a significant amount of money over here.
Right.
Like
It could be 20. Let's just go 2,000 to 3,000 a unit versus 6,000 to 7,000 a unit.
Right.
I mean,
Yeah.
that's the reality.
That's a
Significant.
huge
So-
difference.
Right.
And that work comp carrier may be better at claims.
Exactly.
Right,
Yeah.
which we want to keep that experience mod
right.
down.
So there's a lot of different angles you need to look at when you're taking everything into consideration. Where
Yeah.
before, when we were talking about the race to the bottom, you could mix and match everything, and there was a lot less focus on this.
Right.
But now that we're in this hard market, there's more strategy on saying, hey, yeah, we may give up a little bit here to be able to gain this market over here.
Yeah.
Right. So
We just saw that actually with a client in the Southeast, and we moved the workers' compensation carrier over specifically so we could get this auto savings.
right.
And if you look at it just in the overall portfolio of the policy insurance, like it's significantly less.
Right.
Being able to attach that work comp and auto.
Right.
Than it would be going and starting to try to piece everything together.
Right. I mean, I would just tell the listeners this is why you want to work with somebody who specializes in this industry and has been doing it for some time. This is more of a mature strategy, which is, let's put the pieces of the puzzle together right now, but let's also think how these puzzle pieces are going to be put together next year, the year after, right?
Yeah.
There's strategy. It's not about the lowest price. It's about the strategy.
Yeah.
Yeah, this makes a lot of sense. A lot of companies are curious about captives versus guaranteed cost programs. Generally, when do you start talking with companies about looking at a captive product? And what does that look like?
Well, so when you're looking at like just captives, but also just large deductible programs,
Right.
and we're
Yeah.
talking like anything over $250,000.
I'd say at
the
least.
deductible.
Very-
Like that,
yeah.
like
Oh,
that's-
deductible, yeah.
So you're looking at like about $750,000 to $1 million in premium.
In premium. So
Yeah.
you're paying $750 to $1 million in work comp premium.
Yeah.
Yeah.
Okay.
It's going to be tricky too, depending on. It might be more if you have armed exposure, because there are some reinsurance carriers that say, "Hey, I know you're doing $750,000 in premium, but you have an armed exposure, and our reinsurers won't allow for that." So
Okay.
it's once you get to that premium level, yes, we can look at it, but there's going to be other factors that, and usually, like if you're paying about that much in your workers' comp or even auto, you probably have stuff a little bit more dialed in. So,
and again, that's the starting point though. So like 750 to $1 million, like you can look at it.
That's the bare minimum, right? Because there's fixed costs there.
1.5 to 2 million. Okay, now you're probably going to find a better breaking point where it makes sense to go that route. Where we're going to take a look at the losses and we're going to figure out, okay, well, had you had this program over the last 5 years, this is what your net would have been.
So you could do a look back on it and say, if you had this in place, here's what this would have looked like.
Based off your historical losses and based off of what the premium would have been here, plus the premiums in the past for either that captive or large deductible program, and then looking at it and then seeing if it was a good decision or not. And we've had, had a lot of those conversations before. Yeah. Even with group now, if you're talking like group captives, the barrier to entry there on the premium is much lower.
It's much lower.
It's like $100,000 plus to 100 to 150. You have some smaller group captives. Typically, like group captives will like 250,000 premium. Now, I've done a couple of those look backs over a 5-year period where it didn't make sense to go in. It didn't pencil out, and that client was like, I was like, hey, you're actually, your combined ratio, it's kind of your loss summary. You're running at a loss, and the insurance carriers have been losing money over the last 5 years.
What's a good loss ratio? Let me ask you this.
Yeah.
Somebody comes to you and they're curious about this. You got to do a deep dive into the losses, but just off the top of your head, you're glancing at a table of premium over 5 years and losses. Generally, where does your head go? This could make sense, and where does your head go where this probably doesn't make sense?
I think for a captive or any type of high deductible program, if your loss ratio is under 30%, is probably.
I'm a little bit more aggressive. I'd probably say 40.
This is your losses divided by your premium.
Yeah. 30 to 40%, probably in that range. Because if you're over 50% or getting that 60% range, that's you're gonna most likely end up losing out. And there's also it's difficult too, because if you're at a 50 or 60% loss ratio, you've got quite a bit of frequency there usually. And so frequency breeds severity.
Piece. Yeah,
and then
it's a one-off. Every 4 or 5 years we get this. Maybe we look at it.
Yeah.
But
so that's why you may want to stay in the guaranteed cost market.
What's kind of interesting though is I have seen a couple carriers shifting a little bit. Maybe not necessarily captive, but there are a few carriers that'll now do a dividend component. Yeah. So if you want to slowly dive deep into that, maybe you could potentially get
some steps instead of just jumping right in.
Yeah,
exactly. Look at a type of program where you could be rewarded for good claims management, good risk management, without taking all of the potential downside loss, and then work your way up through a program. Right?
Absolutely.
There's a couple carriers out there, depending on where you're located, if the state allows the filing allows for a dividend, but I've seen one go up to 46%.
So you get 46% of your premium back.
Return premium
pretty
back,
good.
Which is that is solid.
Yeah.
Especially if you've already priced in the full amount of the contract.
Right.
That's great.
That's just that money comes back, and it's windfall from the gods in some ways, right?
Exactly. Oh yeah.
Generally, how long does that come back? How long after the policy expires?
About 18 months.
18 months afterwards, you do a true up.
Yep.
Okay, interesting on that one.
Versus a captive, you're probably looking like at least. Everyone wants to say, hey, 3 to 4 years, but being honest, you're probably looking at 5 to 6.
Yeah.
Before you actually see any of that return.
Yeah.
So sometimes with the guard firms, they might want to be in. They might think it's a great idea, but they might already have an exit strategy. Like, hey, our goal is to grow this and then potentially sell. Right. So you have to take a lot of different. There's a lot of different pieces before going into a captive.
Yeah.
It's not just instant money getting back.
Right. Totally. Yeah. A little bit of work needs to go into it.
Absolutely.
But can you think of any success stories where the work was put into it, their cost of insurance from a liability and a work comp was driven down and created a competitive advantage?
Oh, absolutely, yeah. I've got a client that was in a large deductible program. We ended up building a captive for it, and basically we ended up taking on more exposure, but reduced their upfront costs significantly, because with insurance, especially with some of these large deductible programs, there are fixed costs, right? And that's usually about 30% to 35%. of their program, and then you look at, okay, well, everything else is kind of underwriting profit. And so on top of that, like if they're doing quite well and they're large enough, you can sit there and say, okay, well, how much risk can we take? Can we take on more risk? What's the risk? What's the reward? And I've had one client that did that, and then we started out with the work comp program like that, and then we've slowly started doing that with the general liability as well as the auto, and just kind of taking on more exposure in order to transfer some of that risk to the insured, skin in the game.
Right.
Not that they, weren't more aware of each claim and how it was, that money was being spent and everything. But now it's like we've got weekly calls on kind of what's going on and, where are these claims at, kind of what's going on from that standpoint. They're just much more involved because it's their money at the end of the day.
Yeah. Right.
So.
Right. It goes back to good leadership too, right? We were talking about earlier.
Exactly.
Cool. Well, Chris, Zach, absolute gold today.
Yeah.
Gold. I appreciate your time today. We're going to put your contact information in the notes, where to find you. And I appreciate you coming on today. Thank you both. Highly interesting.
Thank you.
Absolutely.
Good. Well,
Thanks.
I didn't know insurance could be so exciting.
We made it entertaining. We did.
Yeah, it's good.
Well, I appreciate it. Thanks all for listening to the Insurance Lab.